Well, let's start with the action on Dalal Street, where the bulls bounced back from yesterday's sell-off and did so in style. So we saw the Sensex gaining over 1,500 points today and the Nifty added about 300 points. All of this thanks to strong global sentiment. All sectoral indices closing in the green. All Nifty 50 stocks posting gains for the day. The rally was largely powered by foreign institutional investors who bought shares worth nearly 4,200 crore rupees today. Domestic institutional investors sold shares worth over 650 crores. But that's the big story. Buy figure on the FII side of 4166 crores. Anuj joins us now to wrap up the day's market action. Anuj, what a return by the bulls.
Stunning day for the market. Nobody could have thought that, we will do this kind of market action today. The SGX Nifty was indicating that we'll have a gap up, but the market opened much better than that and then kept building pace through the day. There was not a single intraday dip today. The Nifty was up over 2.5%. The Bank Nifty was up nearly 3.5%. And most of this was domestic in nature because globally there was no signal of something like this from either the US market futures or the Asian markets. The broader market has been very strong. So the big question is this start of something big? We'll find out. Quickly, let me run through the big gainers. Across the board, there were gainers, but financials stood out, whether it was names like Bajaj Finserv, Bajaj Finance or IndusInd Bank. But the real impetus came from the big ones, SBI, Kotak, the HDFC Twins, ICICI Bank, and of course, others as well. On the gaining side, some of the other names which did well, Tech Mahindra, the Tata Group stocks, Tata Motors, Tata Steel, Titan, Maruti did well, Larsen did well, Infosys did well. As I said, today it was, almost like hitting a dart and, throwing a dart and it would hit a winner. The big question is this start of something big? We'll find out.
Anuj, many thanks. Well, staying with the market, shares of Reliance Industries also bouncing back in trade. A day after the company's annual general meeting, multiple brokerages like Goldman Sachs, CLSA, Citi, UBS have a buy rating on the stock with the target price ranging from 2,800 rupees to more than 3,200 rupees a share. The street waving a thumbs up to the new investments proposed by Mukesh Ambani at the 45th AGM. GDP growth data for the first quarter of this financial year is expected tomorrow. A CNBC-TV18 poll estimates a growth rate of 15%, and that is on account of the low base as growth had contracted by 26% in 2020 during the first COVID lockdown. The RBI has predicted a growth rate of over 16% for the first quarter, and our estimate is just below that at 15%. So watch out for the GDP numbers tomorrow. On to a CNBC-TV18 exclusive. Insurance regulator, the IRDAI, has proposed to limit the spending made by insurance companies. Sources say large general insurers have some reservations over the proposed move and are proposing a 30% standard limit on expenses. Yash is here with more. Yash.
Well, 2nd of August was when the insurance regulator IRDAI floated a draft consultation paper suggesting a cap on how much can insurance companies spend. Now, general insurance companies have submitted their suggestions, and there is a major change which has been sought by large general insurance companies here. IRDAI's draft consultation paper suggested capping of expenses of management at 30% or an average of the previous 3 years, but whichever out of the two is lower. General insurance companies want this particular caveat to be removed and have a standard cap of 30% on expenses of management, not having to follow the lower of the two. Now, these large general insurance companies feel that it will be negative for them if they are mandated to follow the lower of the two, which is 30% or an average of the previous 3 years, and it will only further reduce how much they can spend on acquiring business. Now, let's understand this by looking at the large general insurance companies which are in question and how much they've spent in the previous 3 years. ICICI Lombard has spent 28% of its gross premium as expenses of management. New India Assurance has spent 22%, Bajaj Allianz General Insurance at 23%, SBI General and HDFC Ergo at 21% and 23% respectively. All the large general insurance companies and what they've spent as EOM is lower than the standard EOM limit of 30% suggested by the insurance regulator. As per IRDAI's draft paper, if they have to choose the lower of 30% or the average of previous 3 years, the amount that these companies can spend will only get reduced even further. And that's the concern for these large general insurance companies. Instead, if these general insurance companies are given a standard limit of 30% on expenses of management, then how much additional do they get in terms of being able to spend? For ICICI Lombard, it gets 360 crore of additional money in terms of spending. New India Assurance, it goes as high as 2,600 crore. Bajaj Allianz at about 958 crore. SBI General and HDFC Ergo again at 825 and about 945 crore rupees. In fact, my colleague Abhimanyu Sharma spoke to the IRDAI chairman, who spoke about the draft paper on expenses of management and what it aims to achieve.
We have actually put up an exposure draft. Basically, the whole idea is to, rationalize the expenses so that when the pricing issue of the products is concerned, the customer should get the best price at the end of the day. So how do we rationalize the expenses of management? So we had constituted a working group comprising of industry and other stakeholders, and the regulator, some of our people were also there on those working groups. So the recommendation was there that why don't we have a single cap on the limit of expenses on management.
Well, that's the IRDA chairman. From one exclusive to another, the chairman of the Central Board of Direct Taxes, Nitin Gupta, says the tax department has collected more than 4.75 lakh crore rupees so far in FY23 against the budgeted target of 14.2 lakh crore rupees. Speaking with my colleague Timsy Jaipuria, he said the department has conducted search and seizure operations on 33% more groups till July this year when compared to last year. And this has led to an over 500% jump in cash seizures. Take a look.
Till July, the enforcement actions number of groups searched has been 33% more than what had been in the corresponding period in the last financial year. And we have more cash seizure has been made, which is to the tune of around 250 crores as against 40 crores in the last financial year in the corresponding period.
Well, that's the CBDT chief. More headlines. Zee Entertainment has signed a licensing agreement with Disney Star for television rights to broadcast the ICC men's cricket tournaments for 4 years. With this, Zee will get the rights to broadcast the T20 World Cups in 2024 and 2026, along with the One Day World Cup in 2027. Disney Star has sub-licensed the TV rights to Zee after winning the combined TV and digital rights for $3 billion. Disney Star continues to hold the digital broadcasting rights. Airlines have once again reached out to the government to seek help in reducing their financial burden. Sources say airlines are urging the government to rework the ATF pricing framework and move to the mean of Platts Arab Gulf mechanism. Airlines have also proposed that jet fuel be brought under GST. The proposal is under examination by the Aviation and Oil Ministries, but no decision has been taken as of yet. Another CNBC-TV18 news break tonight. The government has started penalizing companies for flouting the EV incentive scheme norm. Sources tell us that the government has put the subsidies of Hero Electric and Okinawa on hold for allegedly claiming incentives for products that are not actually made in India. Parikshit Luthra standing by with more. Parikshit, so the government cracking down. Take us through the action taken against Hero Electric and Okinawa.
After several complaints about EV companies flouting localization or make in India norms, the government has put in checks and balances. Specifically, they brought in an application programming interface which allows the government to ask for digital footprint of these EV companies to identify their extent of localization and what they're actually making in India or not. So we've heard that in the recent past, after complaints, the government has stopped FAME incentives for Hero Electric and Okinawa. The probe has revealed that these companies and a few others have been availing of FAME subsidies, but these products or components which they have sought incentives for were not made in India, but they were made somewhere else. So this is exactly what the government wants to do. Now, through this new interface, the government will be able to check for discrepancies instantaneously. 50 to 60 crores of incentives have been held back, and these will be deducted from future payments to Hero Electric and Okinawa. We believe there are more complaints that the Ministry of Heavy Industries is looking at, and action could be taken in the days to come. At the same time, the government is strengthening the ARAI, or the Automotive Research Association of India, which is the body for certifying electric vehicles and IC engine vehicles. Now in future, because of the complaints on EV range, ARAI will be asked to focus on real-world testing of vehicles to find out the true range, rather than test vehicles in labs and come out with a lab range, which the companies may later boast of, but that may not be the true range which the user gets. Back to you.
All right, Parikshit, many thanks for joining us. On to another interesting story tonight. Kotak Mahindra Bank has responded to recent reports that highlighted significantly high number of frauds being reported by Kotak Mahindra Bank, raising concerns about what Kotak believes is inconsistency in fraud reporting by other banks. Kotak Mahindra Bank says it has raised the issue with the regulator, the RBI. Ritu joins us now to explain. So, Ritu, what exactly is Kotak Mahindra Bank's contention here?
Well, let me first set the context where recent RBI data showed that Kotak Mahindra Bank reported 5,278 frauds in the April-June quarter of this financial year, which is by far the highest compared to all other banks. And this stands in stark contrast when you compare it to, say, an ICICI Bank, which reported 436 frauds, HDFC Bank 303, IndusInd Bank 200, and so on. And it gets even more interesting if you look at the number of frauds reported by public sector banks, which are far larger in size. With a few exceptions like IOB and Central Bank, the other PSBs like SBI have reported single-digit frauds, less than 10 cases. Now, Kotak Mahindra Bank has released a statement which could explain this huge differential. Kotak Bank says comparing the frauds reported across banks is like comparing apples to oranges. It said, and I quote, "We have observed that there is significant variance in what is chosen to be reported to the regulator by other banks. We have appealed to the regulator via letters dated 17th March and 30th of August 2022 to enforce standardization in reporting requirements," end of quote. Now, for the period reported, of the 5,200 odd instances for Kotak, actually 97% are digital and car-related frauds, which often occur because of customers sharing their passwords, PINs, or clicking on unknown links, etc. And Kotak Mahindra Bank has alleged that other banks do not appear to be exhaustively or uniformly reporting these kinds of frauds, which could explain why the number of frauds reported by Kotak Mahindra Bank is far, far higher. Now, is the number of such card and digital frauds actually higher in volume than other kinds of frauds? Well, yes, RBI data does support this. In FY22, for instance, almost 40% of all customer complaints regarding frauds were linked to ATM and debit card transactions or mobile and electronic banking, compared to only 28% of complaints relating to loans and advances. So the summary is, don't just go by headline numbers. There is more than meets the eye.
All right, Ritu, many thanks. The big newsmaker this evening, Hitachi Energy, is betting big on India. The CEO of the company spoke exclusively to us. He said Hitachi Energy is looking at both organic and inorganic growth opportunities here. He believes rapid urbanization and electrification of transport and railways in particular should be priorities for India.
Plan for India is to, if I well remember some data points, to bring or move roughly 270 million people into urban areas. And of course, then to also then electrify the transportation mode, not only electrical vehicles, but also electrify the entire rail system in India, which is absolutely the right priority. We are in a growth pattern. We are hiring in India. We're hiring globally. We're hiring talents and engineers that will help us in delivering all the commitments that we've been making to our customers and the trust that our customers have put on us. Growth is not an issue today, and we're lucky to be in that position, but we need to make sure that we do the right things so that we can deliver on those commitments on time.
And you can catch that entire conversation with the Hitachi Global CEO at 10 p.m. on our Global Dialogue special series right here on CNBC-TV18. We will head into a break, but coming up next, Prime Minister's Economic Advisory Council has released the Competitiveness Roadmap for India at 100. We speak with the co-authors of the report when we return. Welcome back. You're watching India Business Hour. The Economic Advisory Council to the Prime Minister has released the Competitiveness Roadmap for India at 100. It's a blueprint for the next 25 years for India leading to 2047. The roadmap guides the way for India to become a high-income country through sector-specific and region-specific policies based on the 4S principles. The first one talks about prosperity to be matched by social progress. The second states growth needs to be shared across all regions. The third is to be environmentally sustainable. And the fourth is to be solid in the face of external shocks. The report says these 4 guiding principles pave the way for resilience as well as a holistic development of India when we celebrate 100 years of our independence. The roadmap offers a diagnosis of India's current competitiveness level, the primary challenges faced and the opportunities to grow. To take this conversation forward, we're joined by the co-authors of the Competitiveness Roadmap for India at 100 report, Amit Kapoor and Christian Kettles. Thanks very much, Amit and Christian, for joining us here on India Business Hour. And just for the benefit of our viewers, I want to clarify that while the release was done by the Prime Minister's Economic Advisory Council, this is not a report authored by the Prime Minister's Economic Advisory Council. It's a report that's been put together by the India Competitiveness Institute, and we've got the co-authors here. Christian, let me start by talking to you about this aspiration of becoming a developed economy. And this was what the Prime Minister heralded in his Independence Day speech on the 15th of August when he spoke from the Red Fort, saying that we want India to be a developed economy by 2047. I'm looking at what your report says just to understand the distance that needs to be covered. You know, before we go from lower income to middle income and then to, of course, high income status, just to be able to get to high income, that means we need to become a $60 trillion economy, 20 times the size that we are today, and more than 2.5 times the current size of the US economy. So let's start with the diagnosis, Christian, because you have done the diagnosis and then the prescription. The diagnosis of where we currently find ourselves from this goal, this aspiration, this audacious milestone that the Prime Minister set out.
Yeah, first of all, thanks for having us. It's great to have aspirational goals. And I think, those focus the mind. And indeed, as you said, they were the starting point for our analysis. It's important to remember that India actually is one of the 10, 15 countries in the world economy that have done really strong over extended periods of times in terms of their growth performance. But what we've also seen is that just trying to get back to the pre-COVID type of growth trajectory is not enough. As you know, India was slowing down slightly in the years right before the pandemic. And what we try to lay out in our report is really identifying what are the priorities, what are the key levers that policymakers in India should think about if they want to not only go back, but actually even accelerate growth. Importantly, I think it's not just about GDP. And, you mentioned the 4S. It's important, I think, that the Indian society, in fact, societies around the world expect more than simple GDP. They want to have opportunities for all parts of the country. They want to make sure that GDP progress is matched by social progress and better living conditions. And this is the key part of what we're talking about. So although we are economists, I think our sense is really that it's not just about hardcore economics, but it's about an integrated economic and social development agenda that India should pursue over the next couple of years.
Oh, absolutely. I couldn't agree more with you. It's not just the headline GDP number that we should obsess about. It is really the quality of growth that we aspire for. But Amit, let's take the prescription forward now. As Christian was pointing out, we have, of course, made significant progress over the last 75 years, and particularly post-liberalization. And there has been a significant amount of poverty alleviation, but there's also been a widening of inequality, and that's evident year on year. So on that issue of social progression, social inclusion, which I know that you are prioritizing as one of the areas of opportunity, but also one of the constraints, what is the prescription for change?
So if you really look at it, the whole question of inequality becomes a fairly important question for us to answer. Like, the question is for the future is that how do we really reduce inequity that actually exists? And inequity could actually be of a number of kinds, whether it is education, whether it is healthcare, or whether it is providing basic services. So India has actually moved into a trajectory wherein we have tried to reduce inequity over the last few years, especially if you really look at banking, the unbankable, the digitization that has actually happened. But having said that, the most important factor is going to be that how do we create the most appropriate jobs within the country? So one of the ideas that we are really saying is that you have to focus on creation of jobs. That is going to be a very critical factor. And how do we specifically look at that? So there are at least 2 or 3 things that we are making or saying within the report. One is, of course, something called as sector and location-specific initiatives that we need to look at. We need to identify the sectors at the local level. Aspirational District Program gives us some very interesting insights as to how we can look at data and identify the sectors that we need to look at. enabling social policies, like wherein we make some effective transfers that actually happen. We are doing some effective transfers, but more will have to be done. More targeted approaches will have to be developed. The third thing is going to be strengthening the markets. Because we need more competition. Because if we have more competition, that means that we are actually going to be looking at more innovation, more ideas in terms of creating newer business models and things. And then having said that, the government will have to reduce what you would call as the cost of doing business. And then last but not the least is about competitive firms. If India needs to progress, we need to find a way to create far bigger set of enterprises than what we are really doing today. So you need to create that entrepreneurship thing or a ecosystem wherein we are able to create enterprises and cover that missing middle. We either have very small enterprises or we have very large enterprises. There is that missing middle, and we have to create a pathway for overcoming that missing middle that India faces.
Yeah, I just want to pick up important points that you raised there, but I want to pick up on the first issue that you spoke of, and that was in the context of social inclusion and social progression. You said that some transfers are already happening. We do have the DBT scheme, for instance, but a lot more needs to be done. Now, put this into context of the current debate, Amit, on freebies and welfare, whether freebies are welfare or freebies are, populist vote-driving schemes that need to be restricted and need to be curtailed. So within the context of the current debate that we're having, when you talk about transfers, what kind of transfers do you believe we need to prioritize?
So very clearly, when I say transfers, I'm not saying that you have to dole out the money. When we are saying transfers, or when we are saying that you need to focus on social sector, what we are saying is that you need to focus on, say, education. We need to focus on healthcare. These are the two very big areas. The question on education is that how do we strengthen our class 1 to 12 outcomes, because we really do know that if you really look at the NAS scores as well, the outcomes seem to be fairly low. So how do we improve those outcomes? Because there is a clear evidence that is available that higher education would lead to multiplier in income levels that people are seeing. The other thing is going to be how do we improve public safety? How do we actually improve the labor force participation for women? That is what we need to do. So the schemes are going to be reduce childhood poverty, improve your social infrastructure in terms of health, look at the education system, possibly provide childcare services so that people are able to go out and work. That is what needs to be done. It is not that you have to give out doles, you just have to give freebies to everybody. It is a question of strengthening the ecosystem that actually exists and that delivers.
Yeah, and on the issue of bringing more women into the labor force, which has, of course, been declining year on year, we've just got the NCRB, the National Crime Records Bureau's data coming in for 2021, which again shows an increase when we talk about crimes against women. But Christian, I want to come back to the point that Amit was making about job creation, and that has to be a priority for a country like ours. We talk about our demographic advantage and our demographic dividend, but we need to ensure that we're actually doing much better on the jobs front. Now, servicization, that of course has been the story that will need to continue to be part of the story. Manufacturing, the hope is that with the schemes that the government has put in place, we will now start to see the share of manufacturing to GDP go up significantly. What do you make of both these pillars of opportunity? What's holding them back, and what more do you believe needs to be done?
I think exactly as you said, these are two pillars and we must run on both of these pillars. I think there has been a traditional view that people looked at economic development and saw this mainly driven by an increasing share of manufacturing, so-called structural transformation. We've seen that in some of your East Asian neighbors that have been able to use manufacturing growth via exports to create a lot of jobs. Unfortunately, the reality now is that both the global market, but also, quite frankly, the technology context is a different one. There are job creation opportunities in technology. For example, as you see now, the telecommunication production that's going on in India. You just had some of your recent programs on renewable energy equipment. I think there are huge opportunities for India to pursue. But all of that will not be enough. We also need to talk about services. And that's why in our report, we talk actually about a portfolio, a range of different areas of sectors that can be mobilized. Maybe surprising, but we see, for example, healthcare as a key area where jobs can be created, partly because India actually does need to spend more money on healthcare, both from the government side, private sector is already spending quite a bit, but also because this is then an area where a lot of entry jobs can be created, can be jobs for women. Already women are quite strongly represented in the healthcare system. So we see huge opportunities here. Now, importantly, this is not just a matter of money, so kind of pumping more money into the system. But what we point out is that you need to need to think about the regulatory environment, you need to think about the education system in order to enable processes in all of these sectors that can be competitive and that are matched with the type of capabilities that the Indian labor force brings to the table. What we see at the moment is, a red-hot labor market for those that are very well-educated, data scientists and so on. But we need to create better entry-level opportunities for people that are not so well-educated and helping them to getting on the conveyor belt, and over time get stronger and stronger, more productive, and then, quite frankly, be self-sustaining. That's the road to get people out of social dependency on government programs. It's not giving them simply money. We need that for people that are in dire straits now, but we want to give them a pathway so that they can earn their own money and actually have a future that they can be proud of and that they can aspire to.
Right. Amit, I'm going to end with you. Speaking of a pathway, and while we are charting out the next 25 years, let me try and bring this back to the more immediate priorities. So over the next 5 years, Amit, off the glide path that you've suggested and prescribed in this report, what do you believe are the immediate priorities that the government ought to focus on?
Two things which are exceedingly important that we need to actually focus on. One is that reducing the implementation challenge that we actually have. So India needs to improve the implementation question that we actually have. That should be the immediate priority. Government of India does spend a lot of money or allocate budget, but what do we see is that we actually end up having a fair bit of issue in terms of implementation that actually happens on ground. So we need to look at that. Improve the capacity within the government. In fact, we do mention in the report that we need to train the people on the idea of competitiveness, possibly look at how we can really push this roadmap at the level of states and ministries, and the guiding principles should be the focus in terms of really looking at it. And then, of course, if you really look at it, there is a huge set of ministries that India actually has, or huge set of departments. How do we rationalize those? Because interaction within the government should actually get enabled and be faster.
Yes, and you've also proposed an India Competitiveness Council, which actually brings the centre as well as the states closer together to try and achieve some of the goals that you've spoken of in the report. Christian Kettles, Amit Kapoor, always a pleasure. Many thanks for joining us here on India Business Hour. Appreciate your time. And that's it then on this edition of India Business Hour. From all of us here, goodbye. Thanks for watching. Stay tuned. The news continues on CNBC.